Thank you so much again for joining us on our latest episode of Lessons Earned. Today we have an amazing honor and opportunity to be joined by my friend Stephen Decker, Senior Vice President, Head of the Western Region for IPX 1031. Today we're going to dive into a lot of different topics, mostly related to taxes, owning commercial property, some interesting new dates that have been thrown out by the government and the IRS. But Steve is father to two daughters, previously played collegiate soccer. Welcome to the Lessons Earned podcast. I'm Chase Macleod, founder and CEO of Macleod & Co., an industrial real estate brokerage company that in 2 short years has completed over $600 million in transactions with a goal of growing to $1 billion in annual transactions completed. As an only child raised in a single-parent home, I've always had a passion for learning things I was never taught earlier in life. How to make money, how to grow a business, how to be a leader, how to keep the money I make, how to be a better dad, a better husband, and most importantly, how to live a better life. Lessons Earned is a podcast about sharing my journey and others as we dive into all the topics I wish I knew earlier in life and knowing it's never too late to earn those lessons now. To my friend Stephen Decker, man, thank you for taking the time to join us.
Hey, I appreciate the opportunity to be here. Thanks, Chase.
Would you just take an opportunity to just tell us a little bit about who you are in your position at IPX 1031? Anything else that you want to share?
Yeah, absolutely. So I've been with IPX now for a little bit over 15 years. I've been in the 1031 exchange industry literally a little bit over 20 years now. And people oftentimes ask me how I got suckered into this business because I've been doing it literally since I was in college. In fact, my first job was with a 1031 exchange accommodator.
Really?
So when I was a little kid, my best friend growing up, his dad owned a 1031 exchange company. And when I was in college, I'd go away and I'd come back for the summers and, I needed a job. My parents wouldn't let me just hang out at the house, right? Yep. So, go get a job, Steve. So I called up my buddy and said, hey, does your dad have anything going that I could, kind of latch onto? So I started working in this 1031 exchange firm. The first year I was there was basically, in a file room, getting my hands all cut up on paper files. The next year they gave me a little bit more responsibility. I was, walking checks down to the bank and doing some deposits. And then, a couple months before I graduated college, they called me up and said, okay, Steve, the real estate market is, kind of going gangbusters. We need some full-time help. Do you want to make $35,000 a year right out of college with some benefits? I was like, yeah, absolutely. Yeah. So I got my first kind of full-time gig in exchanges, and I've been doing this ever since. So, awesome. I love tax-deferred exchanges. It's really kind of a unique section of the tax code. I love working in real estate and, helping investors to, build and preserve their wealth. That's really why I do this, is to help, everybody from mom and pop that own one rental condo in the middle of nowhere to, all the way up to large institutional investors. So that's a little bit of my background. I'm now fortunate or unfortunate enough, I'm not sure, to be the sales manager for our entire West Coast, which is fun. I get to try to convince. We talk about sports a lot, right? I try to mold people in my likeness, right? I try to convince them to speak how I do and whatnot. But it's really all about trying to find the good fit for them, what works for them, and building the team. So I'm doing a little bit of both. I'm wearing both hats. I'm selling and building. So as a CEO actively recruiting, trying to build sales staff, trying to build other staff, et cetera, I'm fascinated to know your answer to this question. What are some of the key things that you look for in someone you're hiring specifically for a sales role? And what is one or two traits that death taxes, and they always seem to have this trait if they end up being successful? So, our company is big on sales. That's if you don't sell, you don't have business coming in. You can't keep everybody else employed. So we're huge on recruiting, right? For me, it's are you type A? You have to be type A in order to be in sales. You have to be not afraid of rejection, right? Because I'm going to walk into Chase's office, ask him for business, and 9 times out of 10, Chase is going to say, nope, I've got a relationship with somebody else. So not afraid of rejection. That's huge. You've got to be type A. We actually look for athletes as well, because a lot of times athletes are used to failure. Baseball player, you're a incredible baseball player if you fail 70% of the time at the plate. If you're batting 300, you're a killer hitter. So that's one of the major things that we look for. We want people that are driven, and then public speaking is huge for us. I mean, we do a ton of public speaking, so you've got to be able to get up in front of people, explain in a concise but easy to understand method what the subject matter is. What is a 1031 exchange? Right. Because what we do is, it is a section of the tax code. I tell people all the time that they call me up and they say, "Hey Steve, I Googled you, and I did some reading about exchanges online." I always say that's the worst thing you could have done. Like, don't read about these things online. Just call me. I'm going to put it to you in plain English. So that's really what we want. We want people that are, succinct with answers, that know what they're talking about, that are good public speakers.
Interesting.
And, bluntly, in my opinion, you can never be overdressed, right?
Okay.
So if you come in looking like a slob, you're probably not going to be able to cut it out there in the real world.
Interesting.
So I've never had anybody, I've had a few people make fun of me for wearing a suit, when it's 125 degrees and I'm out in Palm Springs and I'm wearing a suit.
Right.
They kind of make fun of that, but I know that they're going to remember me.
For
and
sure.
They're going to remember me for a good reason. They're not going to remember me because I look like a bum. So,
isn't it fascinating that I'm asking you a question about what you're looking for in new candidates, and you described 3 things that could not be more old school as it relates to the type of person we need to be. You talked about the ability to consume information and knowledge and regurgitate it.
That's right.
The ability to present, which involves written skills, verbal skills, etc., and the ability to show up and look professional.
Yeah,
I'm so fascinated with that, Steve, because I always say this: AI will make our lives easier potentially. Sure. I don't think it will replace us for what you and I do.
Absolutely not.
Because ironically, you would think as the transactions get bigger, people would find ways to kind of like cut us out. I think as the transactions get bigger, the need for human interaction gets even deeper.
100%. I mean, just to piggyback off that, I was at a meeting with a customer on Friday of last week. I went out to Temecula, met with the customer face to face. Towards the end of the meeting, we were there for probably an hour and a half. Towards the end of the meeting, he said, "You know what, Steve, I'm going to be honest with you. I've shopped it. I've reached out to a number of different exchange companies." And at that point, I kind of got that like sinking feeling, like, oh man, did I just waste an hour and a half of my life driving out here, talking to you and whatnot? And he said, "But I'm going to go with you because you were the only one that was willing to meet with me in person. And you not only were you willing to, but you emailed me back and sent me a bunch of dates that worked for you." So, he just wanted that belly to belly. And I think that's what, if you're going to trust me with $16 million of your money, you want to know who I am, what I'm all about. Do I fit your line of business? Am I going to be able to answer your questions? You can put a facade on over the phone pretty well, or behind a computer screen. But when you're sitting face to face with somebody, it gets a little bit different. So that was a recent win that I got, literally just because people want that face to face interaction.
Awesome.
And I think even more so now, post COVID, right? It's like, how many meetings did you take during COVID where it was virtual? And it's like, I got a lot done, but I didn't like it. Right. I'd much rather be sitting right here next to you than, doing this on a virtual call from, an hour down the road.
Yeah.
So
it's also interesting that you pointed out that the client appreciated not only the willingness to come meet in person, but the willingness to follow up enough and give options until the meeting was set.
That's right. I wasn't going to let this guy off the hook.
Yes, it's very interesting. So when this podcast is relatively new, but conceptually, when I thought of the idea, you have your day job, I have my day job, it's all related to real estate. I had this calling to do a podcast, but when I was thinking about what it was going to be about, I made the decision. I said, it's going to have to be something that I'm personally passionate about.
Sure.
Otherwise, I'm going to find excuses not to do it.
Yeah.
Right? Because the immediate gratification is not necessarily there. It's got to be a hobby that I can find a way, like the Venn diagram, it can kind of work within my daily life. And the concept of lessons earned is finding ways to kind of curtail the learning curve, right? And through amazing guests or through other things that I may speak about, what I've noticed and I've been really surprised about, the topics we're going to cover on this show would be, how to be a better dad, how to be a better husband, maybe leadership, maybe sales, but a lot of it's going to be real estate related.
Sure.
And what I hope our listeners to this episode in particular can take away is if you own any type of commercial real estate, and I cold call for a living, I know you cold call a lot on a living, I am consistently surprised at the individuals, especially business owners, who have spent an entire lifetime becoming so good at their craft and how uninformed they are as it relates to the 1031 process.
Yeah,
I am consistently blown away by it. So I want to take an opportunity. This doesn't need to be a dissertation.
Yeah.
But I would love for anyone that doesn't know what a 1031 exchange is, give us some insight as to what it is.
Okay.
Give us some insight as to how much power it gives an owner of commercial real estate if they are looking to sell.
Yeah.
I'd love for you to dig in a bit on how complicated it can be without the right team.
Yep.
And then dig in on some interesting facts that have occurred this calendar year in particular and that people may not be aware of. So that's a lot, and I'll come back to it. But
yeah, you come back with a few of those questions because I'm not going to remember all five
right I will. Yeah.
But okay, so first and foremost, what is a 1031 exchange, right? A lot of times, to your point, you're 100% correct. It shocks me. I go into offices all day, every day, whether it's residential real estate offices, commercial brokerage offices, law firms, CPA firms, wealth advisors, to educate them on the benefits of exchanges. And it shocks me how many, not only principals, owners of real estate themselves, but actual, industry professionals don't know much, if anything, about 1031 exchanges. So in its simplest sense, a 1031 exchange is a section of the tax code that allows you to sell your investment real estate and defer paying all of your taxes as long as you meet a certain set of requirements that the IRS has. So exchanges have been in the tax code in one form or another for over 100 years now. And historically, they were utilized by farmers. You were a beet farmer. I was a corn farmer. You were sick of beets. I was sick of corn. And what we did is we just traded our properties. I took your property. You took my property. And because neither one of us made a profit or pocketed a profit, why should we have to pay our taxes? That's kind of the general sentiment or the kind of the history of why exchanges exist. Now, through the years, it has morphed into something a little bit different. Chase is now selling his property. He doesn't want the property that Steve's got, so he wants to go buy a different property. So you now don't have to do a straight trading of properties, but as long as you meet the set of requirements that the IRS has, they say, look, Chase, you can sell your industrial building, and if you've made, let's say $5 million of profit on that property over the last decade that you've owned it, when you sell it, you can defer paying 4 different taxes. And so what an exchange does is it really helps you build and preserve the wealth that you have accumulated in your real estate. So instead of every time you sell a piece of real estate and you write a big paycheck over to Uncle Sam and to Uncle Newsom, the government says, all right, Chase, I'm going to let you keep the taxes that you would normally pay on that $5 million of gain, as long as you go out and stimulate the real estate economy.
Right.
So, if you sold a building for, let's just say $10 million, they want you to go buy something for $10 million or more within a certain set of time periods. And if you do that, the IRS allows you to defer your taxes. Now, one thing I want to kind of key in on here, 1031 exchanges are really for any type of investment real estate or real estate that you've used in your business or trade. So it's not just limited to commercial real estate. Sometimes I have customers that say, hey, Steve, I want to sell my office building and I want to sell it for $10 million and I want to go buy 5 or 6 single family rentals. Can I do that?
Right.
Absolutely. You do have the ability to go from residential to commercial or vice versa. Vacant land is something you can also exchange in or out of. Sometimes people think that the property has to be income producing in order for it to qualify. But as long as that property has been held for investment purposes or in the productive use of your business or trade, you work with a lot of industrial owners, owner users on the commercial side, absolutely can do exchanges. So,
and it also applies to apartment complexes.
Yeah, absolutely. So if you want to sell your industrial building, buy an apartment complex, go for it. If you want to sell apartments and buy retail, go for it. And you can move about the country as you see fit as well. I mean, again, kind of piggybacking off of COVID, I'm based right here in Southern California. I started to see a lot of my customers during COVID exchange out of state.
Right.
And the reason for that was a lot of people that had sort of normal 9-to-5 jobs that they could do remotely, they were sitting there scratching their head wondering why they were giving 10, 11, 12% of their paycheck to a state like California with a really high state income tax. So they started moving to states like Nevada, Washington, Texas, Florida, Tennessee, states with no state income tax or lower state income taxes, and they were taking their investment properties with them because it's really hard to manage an industrial building from 2,000 miles away. So they'd sell here and they would exchange into a property in Tennessee. So the ability to move about the country and switch those property types, that's really one of the major benefits of exchanges.
Is there truth to the state-to-state clawback that was kind of rumored to be out there?
Yeah,
you can touch a little bit about what the rumor was, or maybe it's a fact. But I had heard about the Franchise Tax Board saying, in so many words, you better keep exchanging.
That's right.
Because we're going to go find you. But, I mean, speak a little bit to that.
There's really only one way to completely avoid paying your taxes. Nobody wants to do it. We're all going to do it, and that's die.
Right.
So the only way to completely avoid paying your federal capital gains tax, or in this case, your state income tax, is to exchange or hold on to your real estate until the day you die. Okay. At which point all of your back accumulated taxes die with you. So there will be a step up in the basis of the real estate. But what you're touching on is what is kind of industry slang term is what's called a clawback provision. So the state of California got sick of seeing investors from out of state buying real estate here in California, making a profit, selling their property, and taking their money back to New York or Texas or wherever they reside. Because what was hard is the Franchise Tax Board would have to try to trace down tax dollars all over the country. Because those people would say, basically, catch me if you can. So California got sick of seeing that happen, and so they have implemented what is referred to as a clawback provision. So California basically says you can do a 1031 exchange where you sell California and go buy in a different state, but you're going to be forced to file an informational tax return each and every year with the state of California, showing that you still own that property that you bought in, let's just say, Texas.
Interesting.
Right? Because if 20 years from now you sell that property in Texas and you cash out, California comes back and says, hey, remember that building you sold in Orange County back in 2023? You now owe your back taxes. So they're clawing back your taxes.
So would it be based on what taxes they would have owed had they not 1031 20 years ago, or does it?
So it's whatever the tax rate is at the time that you sell. So if 20 years from now the tax rate in California is 20%, the gain that you made while you were doing business in the state of California would be taxed at a rate of 20%. So you're only paying the taxes on the profit that you made while you were doing business in California, but you're paying it whatever the current tax rate is at the time that you sell, 20 years from now. So, and there are actually 4 states that actually have piggybacked off of this. So California, Oregon, Montana, and Massachusetts are the 4 states that have kind of glommed onto this idea and are starting to do this. And bluntly, I think more states will start to adopt similar policies because you're taking tax revenue away from one state and putting it into a different state. Nobody likes it, but it makes sense from my perspective. So,
what are some of the most common questions that you get from new clients who have never 1031 before that consistently come up time and time again?
Yeah, the most common one that we get, well, there's 2 of them really. They're probably the most common. There's a lot of misconceptions out there about exchanges with regard to how much you have to reinvest. A lot of times my customers think that they only have to reinvest their profit, the gain that they made, or they only have to reinvest their equity position in the property that they sold. And again, that's not really true. It doesn't matter if you made $1 of profit or $1 billion of profit. If you want to defer all of your taxes, the IRS wants you to buy for equal or greater value. So if you sell for $10 million, you got to buy for $10 million or more in order to defer everything. Now you can buy for less than $10 million. If you find something that's $9 million, you can defer your taxes up to the $9 million mark, but you're going to pay taxes on the $1 million that you didn't reinvest. So that's one of the big misconceptions. And then the second one is about the timelines. So from the time that you close the property that you're selling, the IRS only gives you 45 days to identify property that you want to buy, and they give you 180 days to actually close on whatever you're going to buy. The number one thing that my clients like to yell at me about is that 45 days, right? They think that Steve Decker's the jerk that's only giving them 45 days to identify property. I always tell them these time periods have been the same.
It's pronounced Sam.
That's
not Steve. Sam.
Right. Yeah, with a totally different exchange company as well, right? Yeah, it's Uncle Sam. But the reason that Uncle Sam wants you to only have 45 days is he either wants you to immediately reinvest, because the sooner you reinvest your money, the sooner you pay transfer tax, property tax. You start generating income again, which means you're paying income tax. Or Uncle Sam wants you to fail, because if you fail, then you pay your federal capital gains tax, your
Right.
state income tax,
Right.
depreciation recapture,
Yeah.
et cetera. So the question that always comes up is, can I have an extension to these timelines? Is there any way that I can extend my 45-day or 180-day timeline?
Right.
And unfortunately, the answer is generally no. There's really only two cases where the IRS will allow you to extend these time periods.
Okay.
The first would be military deployment. So Chase, you'd have to enlist in the Navy and get deployed overseas in order to get an extension.
Okay. So you couldn't just be reserves. You would have to be deployed.
You'd have to be deployed overseas.
Okay.
Yeah.
Interesting.
And then the second would be federally declared disaster. And when I say federally declared disaster, that typically means earthquake, fire, flood, tornado, hurricane, act of terrorism, or for 3 brief months in 2020, pandemic.
It's not just in-laws coming into town for 2 weeks. That's not in the
that is
category.
a total disaster.
Got it. Okay.
But
But not according to the IRS.
Not according to the
Got it.
IRS.
Okay.
Yeah, I actually had a client one time yell at me and told me that he wrote his dissertation on 1031 exchanges, and he was positive that he could get himself an individual extension to those time periods. I said, look, dude, go ahead and call the IRS. If you get an auditor on the phone or somebody that will put it in writing to me, giving you an extension, we'll go ahead and honor it. But we got a nice little CYA for you to sign
Right.
up.
Yeah.
But interestingly, right now, you wouldn't really notice it looking outside right now. It's actually pretty sunny today, but we are in the midst of a disaster here in the state of California because we don't really like rain, right? So the heavy rains that we had in December, January, and actually this month, March, the IRS has issued disaster relief extensions for almost every county in the state of California. So if you are a resident of one of these counties, or if you operate your business in one of these counties, the IRS has not only pushed the tax filing deadline. Most people are aware that the tax filing deadline got pushed all the way out until October 16th. But they also have extended the 1031 exchange deadlines until October 16th.
Interesting.
Yeah. So, I mean, this is huge. I've been doing this for, like I said, over 20 years.
Yeah.
This is a totally unprecedented extension. This is a great thing for our customers to take advantage. I mean, if you were even thinking about selling an investment property in the next year or two, now is the time to do it, because you could literally list your property today. Let's say you close escrow on it on May 1st.
Right.
Typically, from your close date, you only have until roughly June 15th to identify what you want to buy.
Right.
But with this extension, you wouldn't have to identify or close until October 16th. So
Which
you'd
is
have an
unbelievable.
yeah, it's nuts. It's nuts. I mean, it's incredible, but
Yeah.
it's a great opportunity for our customers to take advantage of that
Very
and really
interesting.
not have to sweat out that 45-day identification period. So
Also, since we're on the topic, another misconception that I've run into with my clients, which thank God I use you as the accommodator. There always seems to be a bit of disconnect on how many properties you can identify on that list. So give us some insight on that as well.
yeah, so the IRS gives you 3 different options. There are 3 what are called ID rules, and your customer has to choose one of the 3 rules. The most commonly used identification rule is called the 3 property rule. So under this 3 property rule, the IRS allows you to identify your top 3 choices, basically your plan A, your plan B, and your plan C. So they limit you to only identifying 3 properties, but the good news is there's no cap on the value of those 3 properties. So for example, again, if you sold for $10 million, you could identify one property that's $10 million, one property that's $11 million, and one property that's $500 million. And as long as you can close on at least one of those 3 properties, you'll have a successful exchange. Now, if you called me up and said, "Hey Chase, I've got a client that really wants to diversify. He wants to sell for $10 million, but he wants to go buy a bunch of, smaller properties spread across the country. Is there a way that he could identify more than 3?" The answer is yes. You could use what the IRS refers to as the 200% rule. So under this 200% rule, you take the gross sales price of the property you're selling. So in this example, $10 million, and you just multiply it by 2. So 200% of the value of the one that you sold. So if I sold for $10 million, I could identify up to $20 million worth of real estate, of properties. That $20 million might be 50 single-family homes in Detroit, as long as the total cumulative value of those 50 single-family homes does not add up to more than $20 million. So that's typically used by our customers that want to significantly diversify their real estate portfolio. And then the last rule It's pretty asinine. I've had maybe 2 customers that have actually successfully completed what is called the 95% rule. The 95% rule says you can identify as many properties as you want. They can be any value that you want, but you actually have to close on at least 95% of what you identify.
Yeah.
So the only time that really would be effective is if you identified a portfolio. You know, if you're identifying a portfolio of 10 properties where it's basically all or nothing, and the total value of that portfolio is more than 2 times the value of the one that you sold, that's where you would use that rule. But very, very infrequently.
That's a tough rule because I'm trying to understand the equation behind putting that much on a list and still getting 95% of it. I'm trying to figure out like what profile type you would have to have.
You'd be shocked at what we used to get ID forms where people would like write 100 different single family homes on their list. Or like, whoa, unless you plan on buying 95% of these homes. I mean, if you only buy 94 of them, your entire exchange is blown. So a lot of people don't really understand that rule. And so we have to come in and say, hey, look, unless you're buying a portfolio, this probably isn't going to work for you. So very infrequently used. Yeah.
Another misconception that we've had to walk people through is the concept of a reverse 1031 exchange. And, you know, there's so much timing that's involved in a normal exchange, right? But give us some insight on what is a reverse 1031 exchange? You know, what is the process of doing it correctly to the letter of the law? And then maybe share some mistakes that you've seen in the past.
So actually, those customers that undertake reverse exchanges are very successful. They are just a far more complex and therefore far more expensive type of 1031 exchange. A reverse exchange is typically used by the customer that they're super worried about the 45-day ID period, so they don't want to sweat out 45 days. So they'll come to us and they'll say, you know what, Steve, I want to sell this office building that we're currently in, but in the meantime, I have my eye on a building across the street. It's on the market. I want to strike while the iron's hot. Can I actually go out and buy the building across the street first and then sell this property second? Well, the answer is actually yes. The IRS has officially allowed for reverse exchanges since the year 2000. And we do have an entire division that's solely devoted to them. So that's, you know, we have a whole team that just handles our reverse exchanges. But the reason they're more complex is because the IRS doesn't allow your client to be on title to the property they're buying while they're still on title to the property that they're selling. So you can't have what's called simultaneous title. So what happens with a reverse exchange is you actually have to have us, the exchange accommodator. We actually have to go on title to typically the property that your customer is going to be buying.
Interesting.
So you'll write the offer for them to go buy the building across the street. Once that offer is accepted, we will assign into the rights of that contract. And then we create a single member LLC, which goes on title to that property. So, you know, you name the LLC, whatever you want us to name it, you know, 123 Main Street LLC. And we park that property. By park, I mean we go on title to that property until your customer is able to get this building sold and off their books. Now, they still only have 180 days to get this property sold and off the books. But once they do get this property sold, we transfer the ownership interest of that LLC, that property that's parked in 123 Main Street. We transfer the ownership over to your customer. So the number one complication with that tends to be financing. A lot of lenders don't like the fact that IPX is going on title to the building, but your customer is the one that's actually taking out the financing. So the lender
it's still all the client's money.
We're not
debt. Okay, that's interesting.
Sometimes people think, oh, that's great. You guys are fronting me $30 million
nice of you, Steve.
Yeah, that's great. Right?
You get this one, I'll get the next one.
At 40%. Yeah, exactly. If only.
Right.
But no. So the lender would have to approve our non-recourse language, which basically means, you know, if Chase stops paying the mortgage on the property, lender has to go after Chase. They can't come after IPX for the properties. So yeah, so those are if you plan in advance, they're a great tool for people to utilize. Most of our REIT customers, they use reverse exchanges because if you're selling something for $250 million and you only have 45 days to go shopping, that could be a headache. So they'll go out and buy something first or multiple somethings first and then sell this building. So
interesting.
Yeah.
Do you or would a client have the ability to use 1031 proceeds on capital improvements on a different property that they own? How would that work?
Well, so if it's on a property that they already own, the answer is no. So sometimes our customers will say, hey, Steve, you know, I'm selling a property for $1 million. I already own a property that's worth $800,000. It needs some TLC. Can I make capital improvements to the one that I already own? Unfortunately, not through the 1031 exchange process. If you already own it, you cannot do that. But If you don't already own that piece of real estate, yes, there are ways to make capital improvements to the property that you're going to be buying through the 1031 exchange process. So again, just sticking with my $1 million example, if I sold this property for $1 million, and let's say I found a property that I'm in love with that's worth $900,000, and I don't want to pay taxes on that $100,000 delta, it is possible for me to make capital improvements to that property through the 1031 exchange. So again, what happens there is you have us, the accommodator, we go on title to that property that your client would be buying, because the IRS says as soon as your client goes on title to that property, the exchange is over. So if they took possession or title to that piece of real estate and it's worth $900,000, they only get $900,000 worth of credit towards their exchange.
Okay.
But if we go on title to it, and then we take the next 180 days to make disbursements of the $100,000 that's left over to the contractor or the builder as the improvements are being done.
Interesting.
Once the improvements are finished or the 180 days is up, we then turn the property over to your customer, and hopefully by then they'll have spent that $100,000.
Right.
So yeah, if you don't already own the real estate, you can buy it and improve it through the 1031 exchange process. So.
Just capital improvements, or like leasing commissions or tenant improvement, anything like that? If it's coming from the accommodator to the account, would that qualify too?
There's a bit of a gray area there.
Okay.
So the IRS doesn't do a very good job of what they view as improvements that are acceptable or not acceptable. We get questions a lot of times about like soft costs, right? Are those exchangeable or not? We always, if
you were going to do an addition to a building that had an architect and an engineer, yeah.
So we always kind of defer to the customer's CPA on those things.
Okay.
If your CPA comes back and says, I consider these things to be, exchangeable, we will absolutely fund those things. So soft costs and things of that nature, tenant improvements. Generally, the answer is yes. So
considering we have had 3 banks collapse, very recently, why is it so important to know exactly who your 1031 accommodator is?
So not to fearmonger, but that's a great question because. Exactly. 3 banks have just collapsed. A number of banks have had to be propped up by other banks and the federal government in some instances. It's really important to know who you're working with on the 1031 side of things because most people don't realize that my industry is completely unregulated, right? So people automatically think because we are participating in something that's a section of the federal tax code that you have to be licensed or insured to be a 1031 exchange accommodator. And unfortunately, we are not. There is literally zero federal regulation of who can be an exchange company. So like if the guy flipping McDonald's burgers is sick of his day job and wants to open up his own exchange company and start taking in hundreds of millions of dollars of clients' money tomorrow, there's nothing from stopping him from doing that. So how we're a little bit different. We are owned and financially backed by the largest title insurance company in the entire world. So when it comes to financial strength, security of funds, protecting our customers' money, we are literally second to none in the industry. I would put we carry a very large bond, very large insurance policy. We carry a $100 million bond, $30 million of E&O. We have a written performance guarantee that's backed by our parent company that's up to $50 million per transaction. So basically like our parent company guarantees that we have cash reserves to back us out in the unlikely event that something happens to IPX. So, and then as for where we deposit our customers' money, we are, because we're owned by a Fortune 500 publicly traded company, our internal treasury department will only allow us to deposit funds with massive financial institutions. We're generally talking, Citibank, Capital One, US Bank. Everybody says there's no such thing as too big to fail. But if Citibank goes under, the world economy is most likely collapsed. So we've got bigger problems on our hands. So, just make sure you ask lots of questions. For all those people that are out there considering doing an exchange, there may be an exchange company that's a little bit cheaper than us. There may be an exchange company that's closer to your house than us, but there's nobody out there with better financial strength. I always kind of joke with my clients. I say, like, when it comes to buying my groceries, there's a little farmer's market by my house. So I like to go down to the farmer's market, buy my groceries, support the little guy. When it comes to where my paycheck goes, I won't name the bank, but it's at one of the biggest banks in the country. And it's at that bank, not because I necessarily like them. It's because I know damn well that my money's going to be there when I need it. So, it's important to know where your money is.
So given the name of the podcast, in closing, I would love for you to share as many as you would like, but if you could share in closing some lessons that either you had to earn or even some lessons that some of your clients had to earn, right?
Yeah.
Through an example or through a process, etc. But any lessons that had to be earned along the way that you would be able to share in closing?
The biggest lesson for me is, not to be afraid to ask questions. I mean, because, I remember when I was first coming up, I sat with this lady in her office for probably 6 months, and all day, every day, all I did was pester her and ask her question after question after question. And after 6 months, I'm sure that lady hated me, right? But, I asked and asked and asked because I needed to get the answers to the questions because I knew that this was something that I wanted to do. Right. So, don't be afraid to ask questions. So I've got a business partner right now, right? This guy, I went in and did a presentation at a commercial brokerage office. He saw me speak. He decided he was a kind of a tax geek. He got his law degree and was a broker, and he didn't really enjoy brokerage. And he comes to me afterwards and he's like, I want to do what you do. I said, hell no. I don't want you taking my job.
Right.
But he was persistent, man. Persistence wears down resistance. So he came to me, I want a job. I want to work with you. I want to work with you. I want to help you build your team. I want to help you build. Nope. He eventually went to my boss. My boss ended up hiring him without even telling me.
Whoa.
When I found out, I lost my mind.
Yeah.
Right? So guy comes into my office one day, right, and he says, I just wanted to let you know I didn't do this to, upset you, but I want, this is what I really want to do. And I said, well, I'm going to be brutally honest with you. I don't want you. So and he's like, I don't give a shit. This is what I want to do. So I'm here. It was the best answer he could have ever given me. And that was a big lesson for me because this guy has helped me elevate my business. He now allows me to go out and do things with the customers that I like, and he handles some of the other stuff that I'm not so good at.
Interesting.
He is a cold calling machine, right? Just like you are, right? Because he has that brokerage background. He likes to do things. I love to public speak. I like to come on podcasts, things like that. So, don't be afraid to open your eyes to other ideas, things that might make you a little bit uncomfortable. Get out there and just handle your business. I mean, so that was a real big lesson for me.
Awesome.
It was, open your eyes to something that could expand your business.
Yeah.
You automatically think you bring on a partner and they're going to take 50% of everything, not even realizing that, this guy has increased my business, 3 times what it was. So I'm making more money and I'm working more efficiently with my time, and we're covering more ground than we were before. So, it's a huge benefit. So
one of my buddies a long time ago, it was really like the first year I moved to California. It was another young broker I was working with, and we were in the trenches together, so we became close pretty fast. Sure. And we were at some convention for the company we were working for, and over a beer, he goes, "Where did you get your business acumen?" And I kind of did the head tilt. I was like, "What?" He's like, "No, where did you learn what you've learned?" Yeah. And, one of the reasons why I made this podcast was I grew up in a single parent home, only child. And I knew I wanted to be something, but I knew that I didn't have any examples. I didn't really have any, exposure. And so I think I just kind of created this Doogie Howser mentality, reference that no one on this podcast is going to know what I'm talking about listening. But
NPH.
I thankfully had a mentor really early in my career who taught me how to cold call. And he taught me the art of asking questions.
That's right.
And he said, if you can just get really good at that, you don't even really know what you can sell until you know what the person needs. And so I teach that to my guys, but I've really also applied that to my life. And this lessons earned theme is just finding ways to jam with people that have different mentalities, different perspectives, etc., and have a chance to just sit down and ask them questions. And I 100% agree with you, Steve. Being brave enough to go find something that's different and complementary and admit, if I tear a wall down a little bit, not, oh man, what if this doesn't go right? What if this does go right?
What it could be.
What it could be. So I really appreciate you sharing that with us. This is a really complicated topic for a lot of owners of commercial real estate. And at the same token, it's so powerful.
It is.
It's so powerful. So to have the opportunity to sit down and ask you questions for our audience and give killer information, I'm extremely appreciative.
I'm appreciative, for the opportunity. So thank you for having me in here today, brother.
You got it. Thank you again for being here.
Anytime. Thanks. Man.